Well, one of the Fed's biggest critics of late is at it again. Speaking on CBS yesterday, Allianz's chief economic advisor, Mohamed El-Erian, said he fears, quote, a very high probability of damaging a recession that was totally avoidable. Yields tracked higher in the aftermath of Friday's jobs report amid indications the Fed will need to continue its hiking round. Our next guest says a hard landing is likely. Let's get into that discussion with George Bory. He's Allspring Global Investments Chief Investment Strategist for Fixed Income. George, that doesn't sound promising.
Hi, Kiko. Thanks for having me on the show. It's a rough backdrop. It's a rough economic backdrop. And one of the challenges that the Fed faces is that at this juncture in the cycle, good news is effectively bad. And that's simply because the Fed is trying to fight inflation. We know that. They've been at it now for quite some time throughout this year. They still feel behind the curve. We're going to see the data. We're going to see a new set of inflation data on Thursday with the CPI report. Expectations are, headline CPI should come down a little, but core inflation is likely to keep rising. And it's really, when you take that inflation data plus the relatively strong employment data from Friday, it would suggest that the economy in the U.S. is still expanding and it's still chugging along at a pretty good pace. And the Fed has told us very clearly that they want to slow that down. So from other commentators, from us as well, the expectation is the Fed's going to get what they want. They need to slow growth. They will slow growth. And if you look into the first half of next year, the sort of lagged effect of all these rate hikes should start to bite. And so the probability of a recession, it's going up, and we think it's actually going up fairly quickly, and that's likely to really start to unfold as we get into the beginning part of next year.
So how does that set things up going into the next FOMC meeting? I mean, there's certainly a debate on the sidelines that's happening about whether, in fact, the Fed should maybe pause a bit here to really allow for those rate hikes that have already been implemented to take root. Are we getting any indications of that potential pause, especially when you say the risk of a recession is growing?
Well, the Fed has kind of painted themselves into a box. They've said that they're going to respond to the data, and they've sort of taken a much more of a near-term approach. They need to see current data demonstrate that inflation is coming down on a sustained basis. That takes sort of multiple months. It's going to take time. And it's also going to require a broadening out of the data. So the Fed doesn't have a lot of wiggle room in here from our perspective. They need to continue to tighten policy. The question is simply how fast. A pivot at this point, at best case scenario from a pivot standpoint, is they're able to decelerate the pace of rate hikes. Now, if say Wednesday's data surprisingly comes in, below expectations on both a headline and a core basis, that might provide the window of hope, or open the window, if you will, for a bit of hope that a pivot of sorts might be coming. But it's still premature in our opinion. You haven't seen that sort of clear evidence to give the Fed kind of cover to really start to pivot. Now, the one thing that is not really discussed all that much is just market volatility. Volatility in the bond market's very high right now, and it's likely to stay high as long as these expectations for tighter policy continue. With high volatility, comes sort of a lot of movement in prices by definition, but liquidity also tends to dry up. If the market kind of ceases to function, well, then the Fed will have to do something. But we're not at that point yet. The market's functioning. It's functioning at a slow pace, but it is still functioning.
George, really quickly here, it is a holiday today, but when you look at where the 10-year yield has tracked, I mean, we're off of that level of just being under 4, but we're still at 3.88, based on Friday's close. I mean, where do you expect it to track, at least in the medium term?
Yeah, that's a good point. There's a big distinction between the front end of the curve and the longer end of the curve. We've sort of repriced up, if you will. We're up about 25 basis points or so on the 10-year, as you mentioned, up around 388. 4% is sort of our kind of number that we expect the 10-year to consolidate around that number. We would say plus or minus 25 basis points on each side of 4% is really our central case as we go into the end of the year. The front end, the Fed has also been pretty clear. They want to get the front end up to about 4.5% by year end. So a 50 basis point spread, say between the 2-year and the 10-year, with the 2-year above the 10-year, that would be pretty consistent with tight monetary policy, restrictive monetary policy, and that should help slow growth as we go into next year.
George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income. Good to talk to you today.
Thank you very much.